My name is Martin King. I'm a property analyst at Edison Investment Research, and I'm here today with Michael Morris, who is Chief Executive of Picton Property Income, who reported their results for the 12 months to the 31st of March last week. And we're going to talk more about that. Michael, welcome.
Morning.
Could we perhaps start by you giving a brief overview of what was a really exceptional set of results?
For the last year, we delivered a profit of just under £150 million. That was a record for us and really reflected the rebound in valuation of asset values as we were coming out of the pandemic. Our portfolio is quite heavily biased towards the industrial sector, and that was the strongest part of the UK commercial market last year. Activity in the portfolio meant that occupancy was rising, and that's leading to rising income. Rent collection was higher as well, and all of those things contributed to these returns. The other thing I should just say is we obviously, on the back of that rising income, were able to increase dividends during the year as well, and those are now back to pre-pandemic levels as well.
Sector positioning was clearly very beneficial in the year that's just gone. How do you think that will play out in the current year?
So last year there was a clear hierarchy between industrial, then retail assets and offices. The retail performance was heavily driven by retail warehousing. I think this year that returns are more likely to converge. The gap will be much narrower, and whilst I still think industrial will continue to perform best, not least because of the very strong supply-demand imbalance that's out there, I think generally the sectors will converge, and going forwards it's going to perhaps more be about the assets that you own rather than the sectors that you're in.
What do you think will drive growth in the current year?
So there's a number of factors that I think are going to drive our growth going forwards. From an income perspective, we're clearly going to benefit from lower debt costs within the business following our restructuring last year. We've also got the opportunity to grow occupancy. We're currently running at 93%. A lot of buildings were refurbished in the last few months and are coming back on stream as the market is unlocking there. Within the portfolio, we've got a number of stepped rents, fixed increases. That's going to grow income as well. And then just general active management across the portfolio, I suspect. The other thing to mention is that last year we acquired a number of assets more towards the end of the year, and going forwards we'll have the benefit of that income throughout the whole next financial year. And we've got undrawn revolving credit facilities, and clearly if we deploy that into the market, that's another way of growing the underlying income within the business.
And how do you think the sharp rise in inflation is going to impact that performance?
So what we're seeing specifically at the minute in the industrial sector is rental growth that's actually ahead of inflation, and that's due to this very strong demand and limited supply that's within the market. We're conscious that inflation is also going to have an impact on costs. It'll have an impact on build costs, but in an odd way that's likely to limit future construction, and that in turn will reinforce this supply-demand balance that I've alluded to previously. So the property sector generally benefits from rent reviews at regular intervals. We've got reversionary potential in the portfolio, and clearly we'll be capturing that as we move forwards. So the other thing to mention is that as a business, when we did our refinancing last year, we're now in a position where the majority of our drawn debt is fixed until 2031 and 2032. And clearly that means that we benefit if rising inflation also cause rising interest rates and rising debt costs.
Bringing all that together, how would you summarize the outlook for the current year?
Well, clearly there's sort of some macro headwinds, but what we're seeing on the ground is actually very encouraging. Last year we had dividend cover of 115%, and as I've explained earlier, there's a number of levers, on debt, on leasing activity, new acquisitions that will, put us, in my view, in a better place going forwards. Last year was exceptional, and we saw very strong valuation gains, and that level of growth is unlikely to be repeated this year with, the headwinds that are with us. But the reality is, on the ground, we're seeing very good occupational demand and rising rents across the majority of our portfolio. Recognizing the acquisitions we've done, the refinancing, the refurbishment into our assets that we're now going to be leasing in the coming year, we're very positive about the outlook.